Let's end with a little bit more vocabulary because you'll see these if you start looking at mortgages or doing your own research. A fixed rate mortgage is one where the interest rate stays the same for the entire term, typically 5 years. The opposite of that is called a variable rate mortgage. In a variable rate mortgage, the payment is fixed, but interest varies according to the prime rate that's fixed by the Bank of Canada. In general, a fixed rate mortgage is very stable. It's safe. You know exactly what will happen at the end of the 5 years. A variable rate is risky. If interest rates go up, you could end up owing more on your mortgage. But if interest rates go down, well, that will be better for you because you will owe less. Then we've got the closed versus open mortgages. In a closed mortgage, if you try to prepay or pay off your entire mortgage or change your payments, there will be a penalty on that. So even if you sell your house mid-term, there's a penalty. In an open mortgage, you can do whatever you'd like. You can make extra payments. Sometimes you can make smaller payments if you need. You can pay off the entire mortgage whenever you'd like. Typically, because you have a lot more freedom in this mortgage, you might have a higher interest rate. Finally, I've said this before, the down payment is not part of your mortgage. It's the money that you pay right away. I'm going to say that a very typical one is 20%. It can be more or less. In Canada, if you have at least a 20% down payment to not borrow that money, then you don't have to pay what's called mortgage insurance, where you're taking out an insurance policy on the mortgage, and that goes to the CMHC. That's a Canadian institute. 20% means less fees, 15% you pay more fees.